Good afternoon, everyone, and welcome to this Investing in Germany online roundtable hosted by REFIRE and Targa Communications regarding real estate debt. My name is Andrew Barber, and I am Managing Director of Targa Communications in London. As many of you will already know, my German is almost non-existent, so I must apologise in advance for any poor pronunciation. During the roundtable, we'll be taking questions from the audience. I would ask that you use the question and answer facility on Zoom. We will try to answer as many as possible over the next hour or so. So, real estate debt. While many traditional lenders and suppliers of finance have retreated from commercial real estate lending in the wake of the global financial crisis, their appetite to lend has seemingly declined even further as a result of the pandemic, with lenders focusing on their existing portfolios. This retreat by traditional lenders and the rapid response to opportunities that can be offered by private real estate debt providers explains why this sector has grown in importance as a source of finance over the last year and a half, often providing loans and terms that traditional lenders cannot or will not offer. To examine the impact of this and to look at the future opportunities for real estate investors and borrowers, we have assembled a highly experienced panel of experts for you today who will be providing you with their views over the next hour or so. To set the scene, before the panel discussion, we have a short presentation from Mr. Andreas Kalusche, Chief Executive Officer of Prime Capital, the independent asset manager and financial services provider. Andreas previously worked for JP Morgan Chase & Co. and HSBC Bank and is currently co-chairman of the German Alternative Investments Association. So, good afternoon, Andreas. If I could now ask you to begin your presentation. Thank you.
Thank you very much for the kind introduction, Andrew. Let me briefly introduce Prime Capital. We are an asset manager founded in 2006. We have 100 employees and around 17 billion assets under management and administration. And we are a fully licensed asset manager regulated by BaFin and the CSSF. We have a couple of business lines that we are looking at. This is the absolute return field and the real asset area in particular, in which also sits our real estate and our real estate debt business. We have invested in the real estate debt sector since 2016 in different parts of Europe, with a particular focus in Germany. We have deployed our capital across different sectors, as you can see on the pie chart at the right top corner. And we have provided senior whole loan and mezzanine financing to both existing properties as well as developments. Commercial real estate debt is part of the larger private debt arena, which is a very important and growing asset class in Europe. Why is that the case? Why is private debt in generally growing? It is because interest rates are coming down steadily, constantly, and will remain very low because the tower on the other side of the city in Frankfurt is buying a lot of bonds and a lot of paper and is holding interest rates down. At the same time, credit spreads are at very low levels, again, for central banks in particular buying all sorts of credit exposure. And investment grade, the blue line on the right-hand side, or sub-investment grade credit are at very, very low levels. When we look at the private debt arena, when we try to put commercial real estate debt or real estate debt in perspective, we have a very interesting observation. You see different main areas of private credit, which are sought after by institutional investors across Europe and also in Germany, as well as family office. And if you block these subsectors, you have an asset-based lending block where you would compare commercial real estate debt to infrastructure debt or corporate lending. Commercial real estate debt is yielding higher. If you look at the more cash flow-based part of capital structures, where you would compare mezzanine real estate debt with SME lending, either in core Europe and the periphery, you see that spread levels are significantly higher. And if you go to the more opportunistic part of the curve, which I haven't earmarked with a data point on real estate debt, but again, yield levels would be higher than to the other main private debt asset classes. So from a demand perspective, what institutional investors can look at, commercial real estate debt is at the top end of what is available in capital markets. If we look at the supply side of things, the world was all good before the financial crisis. Banks were lending up to very high LTVs. Sponsors were bringing in the equity, no need for alternative capital providers. After the GFC, clearly banks have retreated, have become more conservative. This illustrative example, lending up to 60%, sponsors still with a 10-15% of equity slice, and then there's a lending gap which needed to be filled by alternative capital. And with the sort of the current challenges with the COVID-19 or post-COVID-19 period that we are in, we believe that banks have further retreated. Opportunities for alternative lenders in the lending gap have increased simply because banks have become more conservative. So the supply side is offering a lot of opportunities for investors to look for deployment of the capital. How to deploy capital, you have two very simple examples. One is a more tiered approach, where you would have the sponsor bringing in some capital. You would have a junior mezzanine tranche at relatively elevated levels, and you would have a senior tranche, either being provided by a bank or also by an alternative lender. So that's one stack of a capital structure. Another is one that is developing more intensively in the post-COVID-19 period, is this more one-stop solution, where an alternative lender would provide the whole financing, call it home loan. They would put together the senior and the junior note and would present this financing to someone that seeks capital. This reduces complexity. This allows for quicker execution. This allows for reduced levels on the legal fee side and the transaction fee side, and it offers also the opportunity to achieve a slightly higher yield for an investor. Hence, whole loans are another great opportunity within this real estate debt market. If I look at this whole loan market in a bit more detail, this is in a way our own database where we are looking at spreads and risk levels expressed in LTC or LTV levels. You can see these are the red lines that margins have gone up during the crisis, both on the development side as well as on existing assets. And at the same time, the risk component has come down. So from a risk-reward perspective, this asset class has improved over the last quarters. And summarizing the opportunity for real estate debt, again, looking from a bird's eye perspective for institutional investors, you can see that financings offer a high degree of security. They are very often asset-backed or asset-based. They allow for stable and very predictable cash flows. They allow for high or even very high returns in comparison to other alternatives that investors have. There is very significant capacity. So once an investor starts to look into this asset class, he is not doing this for one or for two transactions per year, but there is an ongoing flow of transactions which are available. And last but not least, for those that are dealing with insurance companies, this asset class has very attractive Solvency II treatment levels, simply because the capital requirements due to the short duration are very low. So overall, this asset class, I think for a number of good reasons, has developed, as Andrew said, very nicely over the years. We think there's good demand and good supply side dynamics, and we quite like to be part of this market.
Many thanks, Andreas, for that insightful market overview. As I previously mentioned, we have assembled a panel of experienced experts for today's roundtables, and I will introduce them to you. Firstly, let me introduce Mr. Hanno Kowalski, who is Managing Director of Berlin-based FAP Invest, which is an investment consultant providing access to real estate investments and debt financing for real estate and development projects across Germany. Next, we have Mr. Stefan Langewell of Engel and Volkers Capital, where he is head of institutional clients. Founded in 2009, the business acts as an independent investment manager for real estate investments, as well as providing tailor-made finance solutions for projects, developers, and portfolio holders. Our third panelist is Mr. Guido Gerstner of Prime Capital AG, whose colleague Andreas just provided us with the introductory presentation. Guido is Managing Director, Real Estate Private Debt at Prime Capital and is involved in whole loan mezzanine lending solutions for real estate investment and development projects. Our final panelist is Mr. Matthias Sandfort of Core State Capital Advisors. Based in Frankfurt, Matthias is Group Head of Debt Finance for Core State, which works with institutional investors, family offices, high net worth individuals, banks, pension funds, and retail investors, providing investment products and services that create lasting value. Finally, I would like to introduce our lead moderator, Mr. Charles Kingston, who is CEO and publisher of REFIRE, the online publication about German real estate for international investors. REFIRE is focused exclusively on reporting in the English language about the German real estate market from the perspective of the institutional investor. Charles studied at University College in Dublin and Middlesex University in London and has vast experience of the real estate and finance markets. So, without any further delay, I will hand over to Charles and ask him to lead the discussion. Charles.
Thank you very much. Thank you also to Andreas for that presentation, encapsulating in a nutshell, essentially, what we're seeing happening in the debt markets. This is a phenomenon that really has certainly taken off since the financial crisis, with all the moves for the banks to boost their liquidity and the regulation coming from Basel III and so on. So what we're really seeing, and it seems to be as if almost every week we're hearing about a new fund setting up in Europe, from either from London itself, looking at continental Europe, or from the United States, looking at both the UK and Europe. So we've got a lot to get through this afternoon, and I think we're going to learn a lot. I'm very glad that we've got such a distinguished panel with us here today. Andrew has just briefly introduced the four speakers, but I'd like to just ask them all, each individually, one after the other, to give a little 2-minute précis of precisely what their role in debt finance is, so that it helps our audience to know where you're all coming from as we carry on with the discussion. Hanno, I'd like to ask you to kick off. Normally around this time of year, FAP does produce a report on this market, probably coming out later on at the end of the year. But tell us from your perspective what you're doing and what your role in debt finance is.
With pleasure. Great being here. Thanks for having me today. As said already, Managing Director and stakeholder of FAP, we see ourselves as pioneers of the debt advisory business in Germany. We've been in the market for 16 years and by now have advised on a capital stack in total of 16 billion euro. Over time. More recently, that being since 2018, we've evolved and bundled parts of our business in FAP Invest. And that's a platform where we make to institutional investors debt investments available, and that through all different kinds of investment vehicles, either through our own mezzanine fund that we have. It's a Luxembourg-based vehicle on a deal-by-deal basis as well, or through tailor-made separately managed accounts. And as you mentioned correctly, Charles, we do our own research as well that we publish. Mezzanine report is coming out this year, and again, very close on the first day of Expo when that happens in Munich. So that's being prepared, and I'll probably have a little bit of insight of findings that we have seen already today.
Terrific. And yes, when you mentioned that you're 15, 16 years, I think in fact FAP is exactly as old as REFIRE. So this was for all of us a baby market when we started out. Anyway, things have moved on. Stefan, tell us a little bit about Engel and Volkers Capital.
Yes, I will. Thank you, Charles. Yes, I'm Stefan Langkabel and joined England Focus Capital in 2017. And as head of institutional clients, together with my team, I'm responsible for the acquisition and, of course, the support and service of our institutional clients. And probably most of our attendees will know the England Focus brand as a worldwide, with his worldwide shops, with his pretty wide worldwide shops, and their focus is the brokerage of exclusive and high quality real estate all over the world. And therefore it's important for me to point out what our business model is, because we are a separate and independent entity as a so-called licensee partner under this brand. And we were established in 2009, started with 2 closed-end funds in the residential segment for private investors, but quickly moved forward more and more towards the institutional investor via some private placements and club deals. And for almost 7 years now, we exclusively concentrate on the institutional investor and deliver investment opportunities, also like the other guys in the panel, especially for the real estate debt segment. And therefore, we established 2 different fund solutions, especially for subordinated financing in the markets of Germany, Austria, and Spain. And what we see, and perhaps this is a part of our discussion, we see more and more demand for individual mandates and custom-made products and structures for our clients regarding their own real estate debt strategy. For example, we are not only operating in the mezzanine business, we are just preparing a structure for a German Versorgungswerk, a pension fund, to allocate a portfolio of commercial financing in Germany and Spain together in one structure. And if the structure fits, it will be able to administrate for the Versorgungswerk under the number 1 in the so-called German Anlageverordnung, so a special quota, and this very special and comfortable quota. So if we want to position ourselves, we are more a solution provider. And at the beginning of a new relationship with a client, we ask a lot of questions. We want to understand the demand and the need, and then we see if one of our established funds might be a good solution, or if there is any other structure we should develop and deliver. And another good point is that we work in this England Focus network, you all know, but as I said, we are independent. We can use the network, the transparency of markets and transactions as far as it's good for us and for our clients. And this sometimes gives us a bit like an unfair advantage regarding special markets, for example.
Well, I was going to say, Stefan, that I'm sure it's the first question you almost invariably have to answer. First of all, to stress that you are not part of the broker network, but that you are separate. But it's interesting that many years later, in fact, you're coming back now, albeit with institutional investors who are looking for individual mandates. And of course, the brand recognition can certainly not, it's certainly not disadvantageous. Matthias, Corestate, a company that we're hearing a lot about these days. Tell us a little bit about the recent history of Corestate's involvement in debt finance.
Well, let me first start in saying good afternoon to the audience, and it's a pleasure for me to being here. Let me start with my current position, Group Head of Debt Finance within Corestate. So that has 3 main tasks. The one is to seek for debt finance on those real estate which is on the balance sheet of Corestate. Secondly, for those real estate financing needs where Corestate is a JV partner. And thirdly, and that might be the biggest part of our responsibility for me and my team, is the real estate financing for regulated vehicles. And you probably know that Corestate, as an asset manager with roughly 28 billion euros real estate assets under management, has a quite significant real estate loan portfolio to manage. The one thing, we do that with roughly 830 people. So secondly, and now when it comes to debt finance, Corestate Bank is part of Corestate Group. Corestate Bank is, you would see that and best translated as a securities trading bank. And one of the core competencies there is to structure, place, and execute promissory notes and securities real estate backed. Be that rated, be that listed, that's all within the competence spectrum. My role within Corestate Bank is heading the banking coverage, and I liked Stefan's explanation and saying solution provider. So if a borrower comes to us and say, well, I have a financing need, so is that zoning for land, or is that permitting the land, or is that construction financing, or even yielding assets? So we could be a partner.
We'll get onto that later on. But right now, I think it's also important for the audience to know that part of this and the deeper involvement of Corestate is through the takeover of Aggregate Financial Services earlier on this year, which is at the root of this deeper involvement in debt finance, right?
Right.
Guido, back to you. Tell us a little bit. We've had Andreas giving us the basic background of you as a big company. Talk to us specifically about real estate debt.
Yes, thank you very much, Charles. Hello, everyone, to the audience. Having a pleasure having you on board this afternoon. So I have three major points which I'd like to share with you. So we are a team of real estate investment professionals acting on behalf of our institutional partners. You won't read a lot about us because we act very secretly. So we are flying under the radar. We are not keen to be seen in the market with all our transactions, which is one of our major points. So we try to be as secret as we can. Second thing is we issue a quarterly debt finance report. So you can find it on our website, which is giving you insights of the recent real estate debt transactions and debt trends that we observe. And third is we can act either via fund models, or we can also act via separate managed accounts. We are not a new starter in this industry. We are quite active since 2016. So we have some track record for over 5 years. Very experienced team. We are acting across development loans as well as existing loans. We are not only acting in Germany, but throughout Europe, which includes core Europe. We are also selectively active in the Nordic markets, and we cover the Benelux markets.
Great. Well, Guido, we're not going to force you to betray any great secrets of your dark ops here this afternoon, but if you could, as we talk about generally, and I think the audience would be interested to know, this whole development of investors getting into the debt segment, could you all explain as quickly as you can or as briefly as you can why this is so attractive? Why are you in this business, and what is the advantage for an investor in investing if your fund's investing in your fund? Hanno.
Oh, it's a long list of reasons. So for one thing, I think there aren't very many alternatives. I mean, this is not a reason for why you should be doing it, but this is what's really pushing everybody to the market to look for alternatives in a greater sense. Fixed income products don't deliver returns. We've heard in the introduction about where interest rates are and they're staying low. So you need to go somewhere else. And just reading the press today, real estate quotas with institutional investors are, way over 10% by now. They are full in many aspects. So from that perspective, if you want to add to that, you have a choice of going into real estate debt. And from a return base, a lot speaks for debt, real estate debt, even over equity. I mean, you're much more flexible. You get bigger returns at the moment, and in many cases, you don't have to foresee the long-term trends in real estate. I mean, the financing that we do typically starts at bridge loans from a year, sometimes even shorter, to probably not more than 3-4 years in total. Whereas with an equity investment, you look at a big trend for 10 years, 15, 20, and longer. So, and that all at returns, if you look at whole loans starting maybe around 3.5, 4, if you look into mezzanine, you can easily have cash-on-cash returns of 6% and higher. And that convinces, particularly institutional investors, big time to look at this. It's steady, quite secure streams of income as the alternative to fixed income products that they, I think, all invested big time in the past, and see maybe some of those, most of those tickets running out.
Matthias, what's your view?
Well, I share that view, and let me add, if you want to invest in real estate and you have the option to buy a property or to lend on a property, so it's also a formula of the volatility of your investment as an equity investor, and you have some volatility in the value of the underlying asset, so you directly have to book it, while real estate, that has a cushion and a buffer in terms of equity. So that might be also attractive. And we just had the yield comparison, so that applies as another argument.
Good. Well, one thing that Hanno mentioned, Guido, is that, of course, one of the advantages is the nimbleness and the flexibility of this form of lending, that you're not locking yourself in forever. Some people are arguing that the bank's retreat is just temporary, and this is largely to do with COVID, and that the banks are withdrawing somewhat, but that they will come back. This is obviously not the view of your house, because I think Andreas mentioned earlier on, you're taking the view that no, debt finance is here to stay and it's going to get bigger. What do you say?
Yes, I think the process is unstoppable. You have senior loans that are perfectly suitable for senior banks. And of course, there are currently some trends in the market that make senior banks a bit more shy, lending against hotels, for instance, lending against retail. So I believe there will be a partial pushback for the banks getting back into the market if the RWAs are reduced, if regulation kicks in. But on the other hand, you have structural reasons that make alternative lending in the market very interesting. Because if you look at it from a mortgage lending perspective, for instance, the gap between the market values and the mortgage lending values is getting bigger and bigger. So if you have a certain level of equity at hand and you'd like to make a transaction, and your senior bank offers you 60% loan to purchase price, you still have a gap if you would like to go for 75% loan to purchase price. And this is in these days when market levels go up and mortgage lending values remain more or less on a stable level, the gap widens. And this is one of the structural reasons why alternative lenders have a sound and stable and sustainable business model if you compare the kind of valuation approach against each other. So banks have a reason to be in the market. They will ever be in the market. But on the other hand, next to the pure view on mortgage lending values, you further have equity, which has to be allocated from the banks against the underlying loans, which is going to increase in the future. So this is a second step, which is which makes our market more attractive, because banks are restricted by equity commitments, which have to be as an underlying on the balance sheet, for example. And third, there is a structural change between the lending process in a bank and the lending process in an alternative lending world. We are much more flexible. We are much faster because our hierarchical levels are slim. We have a very slim hierarchical structure. We have one investment committee. And I think if you ask any one of the panelists, they will all agree that they are a super fast boat compared to the tanker, which can take a huge load, but which requires much more administrative work in the background.
Yeah. That seems to be a common thread running through all the debt providers. In fact, just recently there was one of the big deals in I think it was Deutsche Bank Silberturm. Yeah, they were pretty blunt in saying, frankly, these days we're only interested in the top trophy assets, and for the moment we're leaving everything else aside. Stefan, your target group is obviously not in the 700 million bracket.
Not yet.
But for all of you, asset category plays a big role, doesn't it? I mean, there are certain areas which you're keener to lend on, and other areas that you're probably wishing to stay a little clear of. What's England Völker's Capital's approach to that?
Well, a lawyer would answer, it depends. We have to look on our own funds, and there we have a more conservative view. So we are looking on the quite normal asset class of residential offices in the metropolitan areas, for example. And there are also some guys who are looking for investment opportunities in Spain right now, for example, but not in the mezzanine sector, then more in the senior loan sector then. So yes, there are different views, and as I said, the investor gives a direction and where we have to look for. We can source the assets he needs and structure a vehicle that is fitting his needs.
And are you all seeing a very specific weighting towards a certain preferences, asset category preferences, and against certain others?
Well, right now, I think hospitality is not very there's not very high demand. There might be some, and when I look at high street developments, for example, well, it's not very easy to place this. And I just told to some pension funds, and they're looking for the plain vanilla business residential, for example.
Yeah. Hanno, do you have a cross section of asset categories, or Matthias, do you have clear preferences? What are debt funds seriously looking at going overweighting?
I mean, there's definitely preference, as Stefan said. Hospitality is something nobody wants to do. At the same time, I wouldn't just say it's a general no to what has been a hotel. We see plenty of projects with creative models of how those are being turned into residential or office spaces. So there's definitely a market that hasn't moved away from those assets. It's just it's put to a different use. Everybody wants to do residential. I mean, we hear that from an institutional point of view constantly. At the same time, prices have gone quite up. So we see right now rather large portfolios on the lower end where they're trying to get into residential at the lowest price possible per square meter. Those are maybe a little bit difficult to get financed with institutional names, where we see the opposite. They try to upgrade and upscale their residential portfolios in terms of locations. On the other hand, at the same time, on a general term, there's a pocket of money for almost everything to be financed. What we see differently is there's a need for a certain risk profile rather for a very particular asset class. And that's something we've done more recently. We've actually spec'd out deals that were more simple in the past, taking a senior and a junior, and the deal is done. Now we have a senior, which obviously we've heard from everybody at a lower attachment point, not at 60 or 70% LTV, but more 50 or even lower. And all of a sudden, the mass ticket or the junior ticket can be structured, and that's something we see in demand from institutional investors, that they take a certain share subordinated within the subordinated piece, and you can structure risk returns within the mass ticket. And that's a little bit independent from the actual underlying asset.
Matthias?
Well, there's not so much different from what my colleagues just said here. And to hospitality, I have an own opinion in a way that I say, well, people like to sleep in a bed. They will in a hotel, and they did that 50 years ago, and they will probably in 50 years do that. So that is, for my understanding, rather a dip. But the liquidity in generally in hospitality has shrank. As an asset manager, in my from the debt finance perspective, most transactions are done currently within residential and office sectors. But that is very much linked to the investors' demand. So where the equity is, the debt will follow. And when it comes to structured solutions, the same view here, and we had that earlier. So banks probably are a bit hesitating to lend to old terms. That opens the window and the lending opportunity for private debt. It's subordinated, and probably the banks need to move a bit and be a bit more flexibility to allow for subordinated to be a bit more open to intercreditors. And if they don't, that is the entry card for hold loans and hold on funds.
Guido?
Yes, I would share this mostly. I mean, hospitality itself is going through a harsh time, but from a fundamental point of view, hotels are still required for traveling. And even if we face changes in the usage for hotels, maybe it is less because we take more online models like we do right now, there will be some requirements. And it's an old, but it's a good statement. It all depends on the location. And if you have like a sound location in an inner city, why shouldn't you lend against this in 1 or 2 years now? Yeah, so there will be still some demand for hotels and even for other concepts like micro living or short-term stay models. It is not obsolete, but you have to be very cautious about the location, about the room concepts. Is it a five-star hotel? Is it a 2-star hotel? Is it a budget hotel? So you need to have some good insights into the hotel industry to make the right choice, which asset you'd like to finance.
Okay, so to what extent is the choice of asset category influencing the weighting that's given? For example, it was quite interesting recently. I'm sure a number of our audience would have seen that recent report from Boost Partner on the makeup of the contributions to the capital stack, and there seems to be there's a misperception. If you ask people, they often think that it's about mezzanine lending, whereas in fact, unbeknownst to a lot of people, senior lending has taken over considerably from mezzanine lending. Would that be typical in your organizations?
Well, we see both. So we started with subordinated financing, and this is what we stand for. And same investors now looking for first lien products and asking for it. And when we see some RFP processes where we work together with consultants, for example, there are a couple of investors who start to invest in the real estate debt segment, and they mostly are looking for a more conservative starting point and for first lien products. So it's I think it's a mixture.
Okay. One of the commonly held views is that in Germany, the German debt funds are taking a much more conservative approach, that the US companies, and there's been a whole raft of companies that have been setting up, looking into this market. I often ask myself, how easy is it going to be for them to get into this market? Is it they're sitting there with big war chests, but they traditionally have higher yield expectations. Nonetheless, they're setting up here and they're looking at this market as if there's plenty of fruit out there to be plucked. Tell me where this thinking is wrong. Why are they making inroads into the market in Germany, in Europe, or what's going on?
Well, I try today to make the first statement. So within our brand HFS, we do mezzanine lending. We have more than 1 billion in equity commitments, and we choose that for a return profile with around 20% per annum. So, and if you say risk and return goes hand in hand, so probably that is part of the answer, but that is only one side of the medal. The other one is to have the trust of the investors to provide lending to those business opportunities, and the trust of those institutional investors in the asset manager that they get the money back and that they have a good assessment on the credit risk profile and the transaction risk profile. So I think if I got you right, part of your question was, is it so easy to be in the mezzanine lending shoes? And this is very much a question of your asset management capabilities and finding the right deal opportunities and to present those to the credit decision-making bodies.
I totally agree with this. It's a matter of deal pipeline, and are you able to draw down the capital as quickly as the investor wants, and to bring it into work. And therefore, it might be not so easy for foreign funds or foreign investors to become successful in the German market, as long as they aren't able to have this access to deals. And another point is perhaps the question of deal size. So there's a difference, and our sweet spot, for example, in the mezzanine funds is about 8 to 15 million euro per mezzanine tranche. So we are not in competition with this huge US or Brit funds in this case.
I'd agree to Stefan and would add here, we've seen in the MES report where we keep a bit track of how many players do we have in the market. We've seen particularly international names come and go again.
Yes.
With, I mean,
Right.
the academics will tell you there's an opportunity, but exactly as Stefan said, they will come in and said they'll do ticket sizes in MES 50 million, 50 and up. Or we see, we deal with them a lot ourselves, Korean investors, for example, who want big prime tickets in top locations. How many deals do we have in Germany each year where you can do 100, 150 million in mezzanine at the rates that these investors require? Those deals happen. I mean, we've bundled some here ourselves, but the majority of the business is more in the ticket sizes that Stefan quoted. So in our fund, we do most recently more between 30, 40, 50 million. You can stitch a little bit together in a little club deal here with one or two investors. But overall, I mean, and we probably see a split in total as well. We see a lot of small business as well, which is very, very difficult, even I think for all of us here sometimes to do, because the efficiency simply isn't there. You need 10, 15 million to make it work. But if you take the big private equity houses in the UK, they are not prepared to do a 15 or 20 or 25 million MES ticket. That's just not their structure. And that's all about sourcing and making and bundling that together. And I see that's where the future is of us players here as well, making products available that bundle those together. And then you can, again, as the institutional investors come in and say, I can invest 100 or 200 or 300 million in a certain sector, but I have to be prepared to have underlying 10, 15, 20 different deals.
And Charles, maybe one more thing to add. If I try to enter a foreign market, of course, I need to understand why is there a difference in pricing. If I compare the US market to the European market, of course, there are different setups and it's not directly comparable to each other because you have different security profiles, you have different collaterals that you can use, you have different legal processes to get hold on the asset. So, of course, there must be a difference in the pricing. And if I try to enter such a market and if I sit on big pockets, I would try to understand why is there a difference in the market? And second is, who would I like to team up with in order to manage my money in this market? Can I do it on my own? Do I have the experience? Do I have a team on the ground? Or does it probably make more sense to get a first introduction with some local teams who are able to get the right deals on board to understand the kind of risk profile that the foreign investor is trying to invest in, and take it as a first step. And if I understand the market is fine for me, I take probably a discount in returns in exchange for a higher security level. Then in the second step, I gained some experience in the market, and probably I can set up my own team on the ground in the second step.
Yeah.
So,
which brings us, Guido, to the question of debt advisors. Traditionally, a role which was very common in the landscape of debt lending in the United States, but not so common here. And when I talk with investors, they say, we wouldn't have looked at debt advisors 2 years ago. We'd have gone to the people we know and so on. But that's changing. It can only be to our advantage, or we might throw that into the mix, or even for a lender to have relationships with debt advisors can be helpful. What do you feel? What do you think about debt advisors, and how much effort do you put into broadening your base by dealing with them? Guido, since you're on the subject.
Yeah, I think it's a very biased view that I have. On one hand, it can be very, very supportive if you are a sponsor in the market, having a very small team. Maybe you don't have an expert who is capable to run the finance business. So it makes perfect sense to team up with an experienced debt advisor who has a strong network into the market. If you look at it from a debt fund perspective, it's a very different view because most of the time, debt advisors try to get the best result for the sponsor, which means that you are mostly in competition with at least 4 or 5 other players in the market. And if you're a small team, you try to be as efficient as you can. So if you have 5 competitors and you're running in the same race, you have 4 losers and 1 winner. So you have to make sure if you work with a debt advisor, you have a very sound and stable relationship. You have repetitive processes, and you can rely on his word, because otherwise you spend resources, you spend time, and you give up another transaction, which could probably comparable to the one which you pursue with your debt advisor. And at the end of the day, you're the second winner or the first loser, however you want to call it, and you spend 4 to 5 weeks with a debt advisor.
Okay, so but you concede that it can work both ways, but it may be a question of the function of how much capacity you have. Stefan, what's the Engel & Völker's view of debt advisors? Do you obviously have your own network of brokers, which is not directly part of your business, but do you cultivate and woo other debt advisors specifically?
Yes, so we work together with debt advisors, of course, as we all do, and there's the same experience Guido mentioned. Sometimes you are in a kind of a binding process, and that's not very nice. But when I see it from the perspective of a developer, for example, and as Guido said, hey, we are talking about the German Mittelstand, so they don't have a complete team and with own financing specialists. So yes, Engel & Völkers has its own specialists and its own experts, and we offer this as a service towards the developers to structure their needed finance, and they can mandate us, and so the customer in this case is not the investor, it's the developer, and we are looking for the best solution then. And structuring this solution for the developer, we are looking, is it a solution with our own products, or shall we deliver this financing to another external network where we have around 300 other investors or financial partners which we cooperate with.
And Hanno,
that is exactly, Charles. Yeah. Let me add one word to that.
Please.
This is exactly from which perspective you take. If you are a lender in a tender process, you sometimes win and sometimes lose easy. If you are a borrower, you want to get a job done and you want to cover your financing need. So and that is a playground for debt advisors. We set up a bank for that business, debt advisory, and I started to explain that in that we have the competencies to do debt brokerage within the banking coverage. We can set up promissory notes and securities, real estate backed, and we can have the allowances to place that with institutional investors. So from a borrower's perspective, it makes sense to go to a debt broker because he has a network and he has the competencies to do certain things. And from a lending perspective, it is probably more favorable to have a direct borrower contact in order to squeeze out the competition. So it depends on the perspective.
Yeah, perhaps, Charles, just to give you an idea about sizes, and we are only one of the smaller niche players there, but this team has already 140 million euro in negotiation for financing in the next weeks, and there are more than 350 million on the table, not with a deep view inside, but if you add this with our panelists, I think you have an idea what the market is right now.
Charles, maybe to add to that, because what you asked before, advisory links this piece as well when it comes to sourcing as well. What we see now that we're getting approached from some of the largest names and getting access to the deals in Germany. And it's not only about having a presence, you need to have access to the market in terms of a wide network of lenders that you can work with, understanding the local differences.
Well, it's in your DNA, it's actually in FIP's DNA, really.
I mean, this is where we come from. At the same time, we do like working with advisors, even if we're on the lending side, because sometimes advisors only make the deal possible because they understand of how it can be done. If you have developers in the market, and even some of the biggest names that we've all seen, many don't understand the financing market, and they say, we need money, this is the bucket, and how can you structure this? I mean, there are other very professional as well, but we appreciate advisors who sophisticate the market and who come with a clear capital stack predefined, making our lives obviously easier as well.
And obviously, over time, they build up a knowledge of what investors, what funds can be specialized in what they want to do. So, for example, as an investor, you may not have 10 deals with the same company, but you could have 10 deals with the same broker, right? And that can go on and on. So in a way, it does help to oil the wheels and make the choice of who you talk to more efficient. I'd like to move on, if I could, to we've had an excellent time for the last 10 years. We all know that in Germany, and so far everything's been running smoothly, including or even perhaps even because of the pandemic. But you guys are always on the alert for risks, kind of risks, even if it's short term, and it's not locked in there for the next 10 years in a hotel or a shopping center. But still, you are always assessing risks. I'd like to ask you all, what do you see as the risk in your business now? I mean, there may be if insolvencies, we don't yet know whether there'll be a wave of insolvencies coming down the line, but if there are, what is going to be the immediate effect on your businesses? Who'd like to go first on that?
Maybe because I just picked on before and said, let's have a sophisticated market and the academic approach. I think that's probably the biggest risk if we look at real estate debt. If you start looking at that industry or that asset class just as a asset class to manage in total, I think then you're missing the risk, because it's very much about individual deals. And as we talked about maybe hotels before, I mean, there are good hotel deals, there are bad hotel deals, and you can't put them just in one bucket. So it's very much about, do you have the access to the local market, understanding where it's located, who's the developer, or who's the sponsor of this deal overall, what's their track record, understanding what they have done in the past and what they maybe have done wrong in the past as well. So again, rounds it up that some of the international players don't have that access and expertise in the local market. So I think that's the key part of risk, all leaving to the side of where you sit in the capital stack, how much equity you have ahead of you. I mean, that's all to be played by the books. But we see many deals, and we get a lot of requests from university as well, based on our mezzanine report. Say, can you give us some evidence of what's the fair price at this risk level? I think in mezzanine, it simply doesn't exist. It's not a transparent. It's not a market that's priced that way. It's about having access to the deal, being there at the right point in time. Obviously, yes, measuring the risk and structuring it correctly, but it's not an efficient market.
Probably to add, and I'm very, very blunt on this, but the biggest risk is to have a write-off in my portfolio. Because independently from the asset class, independently from the sponsor, if I have a write-off, it means that I lose money. And it means that my investors are not happy. So that's the biggest risk. Independent from the market situation, independent from any kind of future assumptions, that's the biggest risk. And how can we address this risk? First of all, we need to have a very experienced team, which has seen a lot of cases in the past and which learns from these cases. And second thing is, you need to have a sound relationship to your sponsor, because if you rely on contracts, you're already lost. But you can sort out a lot of things before you get back to a contractual situation.
Well, Guido, you speak directly to the subject of this existing tension, which perhaps has not yet been exposed between senior lending and subordinated lending. So when you talk about, the worst thing that can happen is a loss. Is it not so that there's likely to be a difference between the subordinated lender when the proverbial hits the fan, as we say, if it does? As a subordinate lender, you're likely to want to keep the borrower in business, right? You'll accommodate a lot of the wishes of the borrower, even if he's in real trouble. Whereas if the bank lender or the senior lender will want to close that business down and get out of it what they can. Is that not a tension that affects all of you in your business, Stefan? I mean, this is ever present in all the deals you do, right?
This is always present, and we have to deal with it. We have to cooperate with the banks and the senior lenders, and we try in our own risk management, to anticipate if there's any going wrong in a very early stage, so that we can steer against it or find several solutions. And I think this is a way. But yes, there might be some differences and some discussions with the senior lender. Knock on wood, until now there's zero default in our portfolio, and perhaps because we have a slightly other due diligence system or process in our team. So we do it with an internal team and we do it with an external team to have a verification of our own plausibility check, and this works. But in the case of workout, you have to sit on the table with all the lenders then and find a solution.
Charles,
that's why where the credit agreements become so important, and usually down to just one point. What's your step in right as a subordinated lender? Can you step in and can you fix the deal? And it'll be just a short window that you have where to do that to make it successful. And actually the senior lenders do like that. If you have a strong background, strong network, and said, we can buy you out, we can refinance this. And that's what we've done many times in the past. That's what we see our expertise in restructuring, that we can make that available. And that links then again advisory together, because you need to have that advisory expertise to make it work, or have a strong partner to do that with.
And I think no one wants to have any defaults in his books. If
so, they want to work it out. Absolutely. Yeah. Yeah. And the senior lenders, and let me add that, Charles, the senior lender does not necessarily want to get out immediately. They probably give some time to the subordinated lenders, as Hanno just said, because there are solutions without damage for one party involved, because they want to stay in the business and they are much better covered by their senior lending position. So the solution very much comes from the equity or the subordinated lender. And that is something I agree to my colleagues.
Yeah, I mean, none of you presumably want to what they call loan to own an asset. You presumably you're there for a clean exit down the line. But trouble does happen occasionally. I mean, we've been largely spared, but as we head into a lot of change ahead, will this give an advantage to those lenders who are also, at least they're out there marketing their capacities to be able to handle the asset if trouble does happen, and to go in and take it over and rework it and so on?
Well, first, this is a question of responsibility. First, it is the equity stake, which is responsible for managing its things and its lending relationships. And then if one of these responsibilities, say the equity falls out because it's no longer available or supportive, then certainly these lenders, and probably first the subordinated lender, starts to protect its position on behalf, and that's very much a duty for the, say, debt funds in this example, for the debt funds to protect the investors' money. So this is rather a formula of responsibilities, and it simply happens, yeah.
Good. Andrew, we have some questions. Possibly.
We have some questions, yes, and one from Marcus Kreuter. Good afternoon, Marcus. I hope you're well. Concerning ESG, and he asks, facing the regulatory pressure on institutional money regarding the ESG compliance, are you facing demand from your investors' side to voluntarily comply with such regulatory requirements? Would you define your minimum ESG criteria and then decline deals which are not matching these?
Well, we in Corestate, we have our own ESG team, and so we certainly keep an eye on that. But let's go back to the lending criteria. So I'm very much convinced that ESG criteria will form the transaction profile in terms of selling and letting, and this very much is the solution to any takeout risk lender faces. So it's everything about refinancing. If somebody lends money, what is thinking about refinancing, and the more ESG compliant it is, and think a few years forward, the more ESG compliant it is, the better the takeout risk profile. If you keep all other aspects equal.
Probably one more thing to add to what Matthias just stated. The influence which we have being the debt lender is much lower than the equity piece, because equity has direct control over the asset, and it can actively influence the usage of the asset. If you take some investments on the asset, it is always driven by the equity and not by the debt side. If you take capex measures to reduce any kind of a heat loss or something like that, it's always driven by the equity portion. So yes, we all take care of the ESG environment, and we are all aware of the situation that there is time to be more ESG open, or more open to be in an ESG position, having people on the ground who observe your ESG activities. You have an ESG policy, but the leverage that we have on the debt side is only in selecting the right assets within ESG environment. But actively managing the asset is not our duty, and we cannot control what is exactly done finally once the debt or once the deal is repaid. But yes, and it's not only the environmental part. You have the social part, and you have also the governmental part. And these two duties are much more under our control than the environmental part. And I believe that any one of us is not keen to make business with people who are probably, with negative news reported somewhere, who are acting unethical and stuff like that. So we have more control over the S and the G, and we are less in control of the E at the moment.
Guido, I'm absolutely with you. I was talking about the takeout risks, and that ESG components will have an effect on the refinancing opportunities going forward, because that is a crystal ball we have in our hands as a lender, and say, okay, what happens in 3 to 5 years or even longer? And looking forward, it will have and become a more important aspect to decisions of tenants and also buyers.
Yes, but I would strongly agree on the importance of S and G as well, as that's something that we do control. In our last year's mezzanine report, we still captured ESG, let's say, importance with institutional investors as, yes, we all know we need to do something, but please don't have that affect our interest rates. And that just, when it comes to lending, then that was very clear. Nobody wanted to be quoted on this, obviously. This year, it's much stronger. I said, yes, we need to find investments that are green investments. At the same time, it's still a dilemma. Don't have that affect interest rates. Nobody's willing to do something that's a so-called green investment, and have a lower interest rate to be able to finance that. And there are just not many deals in the market in total. So it is something we don't control in that industry as lending parties, but the S&G and the overall ethics of our own companies and what we can do, that is important. And that's actually what we focus on next to the assets that we're lending on as much, and be as compliant as possible and move the industry forward.
That sounds, Hanno, as if you're saying, as long as we know about as little about ESG as everybody else, we're not at a major disadvantage.
Pretty much, yes. But looking forward, yes, everybody's looking at what's my neighbor doing, what's regulation doing, how are we getting there? And at the same time, we still need to deliver returns in the meantime. And that's I think, an overall problem we have as a nation, or globally, rather than in this industry in particular.
Well, in Germany, we've always been very strong on the E part of it, but the S and the G is particularly the S, when you could be dealing with, tenants in a building who have children working in Indonesia or something like that. I mean, these are things that are very difficult to control. And I take it, you all have your own internal guidelines. But I reading one of the recent reports, we are well underprepared still, given the fact that this EU taxonomy came out a couple of months ago. But I suppose, as you say, as long as you're keeping abreast with it. Andrew, anything?
Yeah, a couple of other questions, Charles. One from Gianluca Martinelli. What is your view on the collaboration with traditional banks, financiers in the context of subordinated financing structures, and what are the potential pain points? And a question from Hans-Peter Duhr. A significant amount of capital is coming from health insurance budgets, with typically shorter durations and higher appetite for returns. Do you share this view? And what is your view on the appetite for such investors for completion risk additional returns?
If you could just go back to the first part of that again, Andrew, and say it again.
Okay. What is your view on the collaboration with traditional banks / financiers in the context of subordinated financing structures? What are the potential pain points?
Yes, probably I can give the first answer on this. It's a very, very big part of our business. since we are the mezz lenders, or mostly more or less on the risky side of the transaction, it is very crucial to have stable relationships to senior banks. I have been working with UniCredit the last 5 years before I joined Prime Capital. So I was head of real estate finance for Region West, and I know the pain points from the senior side. Now changing to the mezzanine side, I know exactly this kind of arguments which they bring up when it comes to intercreditor discussions. So the pain points are, as always, standstill periods. What kind of price level do you agree if you try to buy out the senior lender? So these are typical discussion points that you need to find a way through with your senior lender. But what I can recommend is, once you have your intercreditor agreement in place, never touch it again. Just use it for any kind of next deal. If you agreed one version, just keep it as it is. It has been agreed between both parties, but it's a very time-consuming and a very painful exercise to agree on these kind of details. But to give you a quick answer, it's very crucial to team up with senior lenders in the market.
Stefan, the way you're smiling there, Stefan, strongly suggests that this is a Wunderpunkt with you as well.
Yes, it is, of course, and I couldn't explain it better than Guido. I made the same experience, and in front of my eyes, there's a special project which we couldn't realize due to the fact that the bank wasn't able and wasn't willing to touch the intercreditor agreement, and that was very painful for all parties. But it seemed that the bank wasn't very keen in its own client relationship, and so it happened. So this is a very crucial point.
And let me add that sometimes the experience level on the banking side is another factor, and the question was about pain points, and change of control is certainly one of the pain points, because the subordinated lender cannot be sure that he gets granted the change of control consent and cure rights and cure periods. But Guido had that earlier.
Speed is crucial, I think, in our industry, and I'd add to that, as if you don't have, in some cases, pre-agreed intercreditor agreements, you won't be able to compete. So it's even beyond what Guido said. Ideally, you have those in place even before you have the deal with your major partners that you do regular business with.
Yeah, I think that answers that question pretty well, Andrew. What was the second half?
The second one was from Hans-Peter Duer. A significant amount of capital is coming from health insurance budgets with typically shorter durations and higher appetite for returns. Do you share this view? And what is your view on the appetite of such investors for completion risk / additional returns? Who's going to answer that?
I mean, we do have investors from the health insurance industry. But I don't see them behave very differently when it comes to duration. They have the same demand as life insurances. Yes, their product is a different one, but the part that goes into debt behaves very differently, very much the same as it does from those that have maybe longer duration expectations altogether. So we don't see a difference in the need of return. They all look for, they all have their similar main expectations on the return, and very similar on the risk levels as well. Overall, we are short-term anyhow in what we do here. We don't offer 10-year durations. We usually are looking at 1, 2, 3 years maximum. Even though the funds run longer, the actual underlying investment is always a shorter one.
Okay, we've had another question as well from Nadine Frank. She says, good evening. Thank you for the interesting discussion. She would like to hear what you have to say about the real estate tokenization trend and what role you see for real estate tokenization as a form of financing.
It's going to happen.
Who are the digital experts amongst us here?
Well, perhaps I begin. We have our own England Focus Digital Invest, for example. So it's a crowd investing platform, and all that stuff regarding digitization will come. It started in the private sector, and well, I think I'm not sure if the larger insurance companies and pension funds will step in the near future, but for example, family office or other institutional investors are still looking for. So I think we are it's good for us to be prepared also in this case.
We are doing first deals, but we see them as dabbling in that area, only trying it out, because the size of deals we do, I think particularly institutional investors are now not prepared yet to do a loan of 20 million and have a token in their wallet, not knowing how it's going to be agreed with from Bundesbank, how it's going to be regulated, how it's going to be audited. I mean, there are a lot of things still to be answered, but it's going to come, and it's the moment one of the biggest players is going to solve it for them, is going to accept that in their asset management. It will change the industry big time. So we are doing first deals, but they are, compared to what we are doing overall, still in the, let's say it's a 4 or 5 million that you can do in that area with tokens. It's not the typical size that we normally work on.
Okay. Also had another question from Marcus earlier. He said, following your businesses, I would assume the majority of your debt deals are linked to project development. Could you disclose the share of business in project development, and what is your expectation of availability of such projects in the next 3 years? Who would like to answer that?
Yes, the share of developments compared to existing is 60-40. So we do approximately 60% development loans and 40% for existing assets.
What's it likely to be when Corestate settles down with your strategy, Matthias?
When it comes to Corestate Bank, would say 80-20. 80% zoning and
80% development or 20% development?
It's planning right and building right. So the development of planning rights and building rights. So zoning and permitting. 80%.
Okay. And over at Engel & Völkers?
Yeah, I'm with Matthias in this case. We see more real developments, securing the plot, getting the permission of building, and then building. Sometimes there's a kind of revitalization, but it's absolutely more development.
And Hannah, over the 15 years that you've been in this business, can you say anything about a long-term trend in terms of development versus Bestand?
I mean, existing properties are, and we've seen demand for mezz in that area more recently, particularly with the trend from COVID. We had investors who've probably never tapped the mezzanine market before, and all of a sudden say, I want some pocket money to look out for opportunities. And I have great big portfolios, all with senior lending on it, and maybe down to LTVs 20, 30%. All of a sudden, they say, let's get some quick money here, and let's be ready for some transactions in the market. So we've seen those pop up. And we've seen, obviously, with prices increasing or going up constantly, and the banks not being able to lend on maybe those increased market values, all of a sudden opportunities that come up on the mezzanine side as well. But at that said, obviously, ground-up development is a big part of it. We look at it differently. We slice it usually in different risk pieces. As Matthias says, well, there's the land banking part, pre and after the permit. Then there's maybe the ground-up real development. Then there's the renting period, the sales period. I mean, there's lots of opportunities along the way that are maybe not prime development risks. You might even just take the letting risk or the sales risk, even in a forward maybe where it's been sold already and you just need to bridge it, take a little bit of equity out till the sales price is being paid. So we rather look at it in different slices, and sometimes we take it all, and sometimes we just pick certain pieces from it.
Good. Well, that's a pretty comprehensive set of answers for Marcus there, I think, Andrew. Yeah. With an eye on the clock there, I don't want to run too far over time. Have we a last question or another question we could?
I don't have any other questions from the audience at this time, Charles.
Okay. Happy to offer you all a last minute statement to wrap up before we close down. It's clearly very much the growing area in lending. The common view here seems to be that's likely to be continuing. Guido, you were certainly very bullish on all of that, and the others I think are as well. Anyone else like to say something on where debt lending is going before we close down? Stefan, a last word.
Yeah, perhaps just to add that real estate debt investments are an established asset class right now. So most of our investors, or most of the institutional investors, know about it. Not all are invested, and we all know, I think, from some who think about first-time investing. And yes, we can give them the comfort to get in touch with us all and talk about this. It's an established asset class. There's a huge transparency right now regarding the market and the competitors there, and we look forward to start a discussion.
Good. Hannah, we wrote in REFIRE recently about a major investment into your fund. So there are people prepared to put large amounts of money into these funds for companies with specialized local knowledge. And I understand probably more to come in the next half year.
Absolutely, we have a bright future ahead of us for the industry and overall, and without making it a marketing pitch. So that
Sure.
would be my closing remark, is that if you are thinking about lending and you're doing this as an institutional investor, go and find a partner. Any one of us here or others in the industry, there is much more than just writing an individual loan to get it right. So I think seek advice and look for a strong partner in your local market.
And Matthias, once the banking sector has bedded down within Core State, we're likely to be seeing all sorts of new diversions and directions next year, presumably.
Well, let me. The question was how do I see the financing future? So banks will remain and stay in place. They probably will also change their lending appetite from time to time, but the private debt market will have and become a market share and will stay in that field of business. So, and if you see that from a broader perspective, say with the lending opportunities in total and also the refinancing opportunities, then I think that as I just said, private debt has a good market share.
Good. That seems to be Prime Capital's view as well, Guido.
Yes, thanks everyone for joining us today. We spent more than 1 hour together. So yeah, like I said, it's important to have a sound client relationship to generate off-market deals with an established network of sponsors, which allows you to handle things if things are not working well. We still focus on the ESG topic, which will improve in importance over the next couple of years. It's an unstoppable process since we have structural changes in the banking market, and it's up to you to make the right decisions.
Very good. I'd like to thank you all very much. A very interesting, stimulating discussion, and I'll hand back to you, Andrew.
Thank you, Charles. Yes, could I extend our thanks to the panelists today? That's Hanno Kowalski of FAP Invest, Guido Gersner of Prime Capital, Stefan Langevel of Engelville and Volkers. I've been saying that wrong all afternoon. I know that, and I apologise. Matthias Sandfort of Core State Capital Advisors, and Andreas of Prime Capital for his valuable introduction to the topic earlier. Thanks to you, Charles, from REFIRE for moderating the discussion. And could I thank everyone for attending this event, which will be available to watch and listen to again online very soon. There will be links from the Targa Communications website. Thank you again for your time. Stay safe, and we look forward to you joining us again soon. And a good afternoon to you all.
Thank you all very much. Thank you.
Thank you.
Thank you. It's been a pleasure.
Thank you.
Bye-bye.
Bye-bye.
Bye.